Fusion Mobile, quality e-learning experience on the go.
Insurance. Insurance can be defined as an agreement whereby one party promises to indemnify or pay another party a sum of money in the event of his suffering a specified loss or damages. The main principle of insurance is the pooling of risk. On the other hand, assurance is the provision of cover against some eventuality, which must occur at some time in the future. For example, the death of a person. The history of insurance in Nigeria. Some forms of insurance schemes existed in Nigeria before the coming of Western civilization. The predominant system during this period was the organized social scheme, which included the extended family system, the association of age grade, and other unions. The rationale behind this system was to ensure periodic contribution from members and to rally round any member that suffer a loss such as death, illness, etc. This form of social insurance is still in existence in Nigeria among community groups. In the 20th century, the British merchants introduced modern commercial insurance into West Africa. In 1921, the Royal Exchange Insurance established the first insurance company with a branch in Lagos. This company dominated the scene for 30 years until 1949, when other companies like General Assurance Society and Tobacco Insurance Company Limited were established. In 1950, indigenous participation in insurance business was enhanced with the establishment of African Insurance Company. By the time Nigeria got independence, the number had risen to 25 and were mostly owned by Nigerians. The National Insurance Corporation of Nigeria, NECO, was established in 1969 as a ploy by the Nigerian government to check the operators of insurance business. The Nigeria Reinsurance Corporation was also established in 1977. In the 1980s, the number of insurance companies had increased to over 100 as some reinsurance companies were established. For example, the Universal Reinsurance Company. In addition, over 150 insurance brokers were also registered. At present, the leading insurance company in the country is NECO, which was formerly owned by the federal government, and it underwrites at least 35% of the total insurance in Nigeria. Over the years, different acts have been promulgated to control and regulate the insurance industry. For example, the Insurance Companies Act 1961, the Marine Insurance Act 1961, and Insurance Decree 1976. Today, the current legislation is the Insurance Decree 1991. Presently, the share capital for the setting up of an insurance company has been increased, and new measures aimed at controlling the activities of the country have also been introduced. Some insurance companies in Nigeria are the Reinsurance Corporation of Nigeria, the Lion of Africa Insurance, the Industrial and General Insurance, the Amicable Insurance, and the NECO Insurance. Differences between insurance and insurance are: 1. In insurance, the risk insured against may not occur, while in assurance, the risk is certain to occur. In insurance, it is a provision of cover against eventualities which may never occur, while the assurance is a provision of cover against some eventualities which are certain to occur at some time in the future. Insurance hinges on probabilities, while assurance hinges on possibilities. Examples of insurance are fire, marine, and burglary. Examples of assurance is life assurance. Now, talking about the insurable and the non-insurable risk. Insurable risks are the type of risk which the insurer can make provision for or insure against because it is possible to collect, calculate, and estimate the likely future loss. Non-insurable risks are the type which the insurance company is not ready to insure against simply because the likely future losses cannot be estimated and calculated. For example, loss through competition, gambling, launching of new products, risk to war, loss of profit due to fall in demand. We also have the indemnity insurance. The insured here is restored to his former position before the incident occurred, while the non-indemnity insurance refers to those associated risks for which no amount of compensation could equate to the loss suffered by the insured. Before we look at the types of insurance, we have to consider some principles of insurance. Principles of insurance refer to the basic principles which must be fulfilled in insurance, and they include 1. Indemnity. Indemnity is the compensation given to the insured by the insurer in the event of his suffering a loss. Under this principle, the insured will be given compensation for loss suffered. He will be restored to his former position before the loss occurred. All other types of insurance are insurance of indemnity except life assurance. For example, if a man loses a car, he will be compensated for it. We also have the utmost good faith. This principle states that in any insurance contract, all relevant information that will affect the validity of the agreement must be disclosed by the parties involved. The parties must disclose all material facts truthfully so as not to render the contract void. The true value of the property must not be under or overstated. For example, in a life assurance, if the assured did not disclose to the insurance company that he has a terminal disease before the signing of the agreement when he dies, the insurer may refuse to honor its own part of the contract. Then, the insurable interest. This is one of the principles of insurance which states that one can only insure properties that will bring loss or liabilities to him upon destruction. The properties of a neighbor or friend cannot be insured by the individual. He can only insure property that will bring financial loss to himself. Any insurance without this principle is void and destitute of any legal effect. For example, you cannot insure the motor car of your friend. Another principle of insurance is the proximate cause. The principle states that only the losses or liabilities which arise from the direct and immediate cause of the event insured against are indemnified. There must be a link between the loss suffered and the risk for which the insurance has been taken. The loss must arise directly from an insured peril or must be the result of a direct chain of events initiated by an insured peril. For example, Mr. Joe insured his car against fire, but the car had accident. The insurance company can only compensate if it is fire and not accident. Then we have the contribution principle. This principle states that where a person has insured a certain risk with many insurance companies, he cannot claim compensation in full from each of the insurance companies. This means that each of the insurance companies will pay a certain proportion of the loss. The insured cannot make gain or profit. If he has been settled by one insurance company, he is not entitled to receive contribution from other insurance firms. We also have the subrogation principle of insurance. Under this principle, once the insurer has given an indemnity for loss, he can take over the subject matter of the insurance and the rights relating to it. The principle implies that the insurance company can take over the rights of the insured once he has been compensated. The insurer can take over the scrap and sell it to reduce their liabilities. A very good example in which subrogation arises is in motor insurance. Mr. Abiodun's car had, for instance, an accident, and he has been compensated. The car is no longer his own. The insurer can sell the scrap. We also have the principle of abandonment. This principle states that the property that has been insured may be abandoned in certain cases if its actual loss appears to be unavoidable or if the cost of repairing the damaged property will exceed their value. In such cases, the insured will inform the insurer that he wishes to abandon the goods, for example, as a constructive total loss under marine insurance. We have different types of insurance which a business should insure against. These constitute the various types of insurance, and they include 1, as we can see on the screen, bad debt, goods in transit, group insurance, cash in transit, fidelity guarantee, export credit guarantee, plate glass, agricultural insurance, burglary, theft, robbery insurance, consequential loss insurance, contractor all risk insurance, employer liability insurance, aviation insurance, accident glass insurance, marine glass, life insurance, fire insurance. Bad debts insurance are debts that are difficult to collect. Therefore, bad debts insurance covers debts that may not be paid by the debtors to the business. The risk of non-payment is the subject matter of this type of insurance. Here, the insurance company will guarantee to protect the business against irrecoverable debt. Goods in transit insurance is a type of insurance which covers against accidental damage or loss to goods in transit. It provides compensation to the owner of goods if the goods are damaged or lost in transit. Goods sent by any means of transportation should be covered by this policy. Parcels, letters, or luggages can also be insured under the policy. Talking about group insurance. Group insurance is an insurance taken to cover a group of people or workers. These are policies on a collective basis assuring members of a particular group, such as a football team or a group of employees of a firm. The insurer is liable for everyone covered by the single policy. It reduces the cost of administration, and the dependent will benefit if the worker is involved in an accident. This policy also encourages employees to remain in employment. The cash in transit insurance is an insurance policy that provides compensation to the insured in the event of cash being stolen either from the business premises, home, or while it is being carried to or from the bank. It covers cash taken outside to purchase goods and cash brought into the office for workers' salaries. It may provide compensation to employees who may be injured during a robbery operation. The Fidelity Guarantee Insurance is a type of policy effected by an employer, insuring him against the possibility of the dishonesty of an employee. The object is to provide cover against loss by reason of dishonesty of people holding positions of trust. This is taken by a firm to guide against the risk or loss arising from misappropriation of money by the employees in charge of cash, for example, the cashier, accountants, etc. The Export Credit Guarantee. The Export Credit Guarantee Insurance is an insurance policy that provides cover for exporters against the major risk of exporting. It guarantees to cover exporters of goods against the risk of bad debt as a result of goods sold to foreign buyers. Some uncertainties in international trade, like insolvency of buyers, action of some foreign government, for example, preventing performance of contracts, civil disturbances and exchange control difficulties are also covered by this policy. Some functions of export credit guarantee includes 1. Covering non-payments by the buyer, indemnifying the exporter in the event of non-payment and encouraging sales of goods on credit in the international trade. The glass plate insurance policy. The glass plate insurance policy covers accidental damage to glass plates, windows, doors, and shelves. It guarantees to cover for the replacement of plate, glass windows in the event of damage. For example, the 80 Beds Place, which is a glass house, on Mobolaji Bank, Anthony Way in Ikeja, Lagos. Talking about the agricultural insurance. It is a type of insurance which provides relief to farmers for losses suffered on their crops as a result of drought, pests, and diseases. The burglary, theft, and robbery is a policy which provides compensation for losses which may arise from goods or property stolen or damaged through breaking into a shop or business premises. An individual can also take this policy against the risk of losing his house properties to thieves. As a matter of necessity, it must be proved that thieves have actually broken into the house and carted away the property under consideration. We also have the consequential loss insurance. The consequential loss insurance is a policy that covers losses to commercial firms after a fire incident resulting in interruption of business activities and stoppage of production. It covers loss of profit arising from the stoppage of the production processes. Talking about the contractor all risk. The contractor all risk provides for contractors in the event of any damage being done to the construction work from a wide range of perils. The risk is that the project may sustain severe damage and this would delay the completion of the project. The employer liability insurance. The intention of employer liability insurance policy is to ensure that the employer does not suffer financially but is compensated for any money he may have to pay in respect of a claim to provide compensation if any employee was injured or killed. This policy provides cover for employers in the event of liability to employees arising from industrial fatality, disease, or injury. This insurance gives employees some protection. The aviation insurance is an insurance against all risks associated with the use of aircraft as a means of transport. The component parts and complete jumbo jets are all insured in the aviation insurance market. The buyers are large commercial airlines, aircraft users, and private owners. The policy also covers the aircraft and the liabilities to passengers. The accident insurance policy is a policy that guarantees the payment of compensation in the event of an accident causing death or injury. This insurance covers protection for death or injury arising from accidental, violent, external, or visible means. It can cover personal accident, sickness, etc. The motor vehicle insurance is an insurance policy which provides for liability for death or bodily injury to any person arising from the use of vehicles on the road. Compensation will be paid to victims injured in road accidents. The insurance companies base their premiums on the types of cover provided, the size, value of the vehicles, etc. Most drivers have either the third-party insurance, the third-party fire and theft, and comprehensive policies. The third-party fire and theft, in addition to the cover already stated, covers damages to the vehicle as a result of fire and theft. The policyholder will be compensated in the event of losses suffered from fire and theft of the vehicle, while the comprehensive insurance covers the driver, the insured vehicle, third parties, and sometimes the contents of the insured vehicle. It covers virtually all accidental damages to the insured vehicle and losses arising from fire or theft. The comprehensive policy attracts high premium. The marine insurance is a branch of insurance which covers losses or liabilities relating to ships and their cargoes against the dangers or perils of the sea. This is probably the oldest form of insurance. The perils of the sea includes storm, tempest, collision, theft, and fire. Marine insurance policy is compulsory in international trade so that all goods passing through the sea, including the ships, must be covered by marine insurance. Lloyd's of London is considered as the largest marine insurance in the whole world. Features of marine insurance policy includes covering risk associated with sea voyages. The ship owner can insure his ship against loss as a result of fire, storm, or collision. The cargo can also be insured. The ship owner can insure a ship for one voyage or for a specific period of time. We have different types of marine insurance: the hull insurance, the cargo insurance, the ship owner's liability, the freight insurance. The hull insurance is a policy which covers the ship against damages which may result from the perils of the sea. The cargo insurance policy is a policy entered into to cover goods or cargoes carried by a ship. The cargo insurance is very important in foreign trade, and it must be stated whether the importer or exporter will be responsible for the insurance of the cargo. The ship owner's liability is a type of insurance that covers all risks or losses for which the owner of the ship or its employees are liable for negligence in handling of goods, injury to crew on board, damage to other ships or to ports. The freight insurance is a type of policy taken to cover against refusal to pay charges for lifting the goods. The shipper covers himself against loss for sums paid out in freight if the cargo was lost in transit before reaching its destination. The types of marine insurance policy includes time policy, voyage policy, floating policies, mixed policy, construction policy, open cover policy, valued policy, unvalued policy, fleet policy. Marine losses can be categorized into total loss and partial loss. Total loss occurs where the subject matter, that is the goods, are completely destroyed. And total loss can be subdivided into actual loss and constructive loss. Actual loss is a type of loss which occurs when the goods are completely destroyed by fire, while constructive total loss is a type of loss that occurs where the objects insured have to be abandoned because what is left is beyond economic repairs. The partial loss occurs when there is damage to a portion of a ship or its cargo. It can be categorized into the general average loss and the particular average loss. The general average loss is a partial loss which occurs when the shipmaster, for the interest of the parties, deliberately and reasonably throws overboard or jettisons some of the cargoes in order to lighten the ship so as to reduce loss. The expenses will be borne by all parties concerned. The particular average loss occurs when the cargo or ship suffers partial loss or damage. This loss here is accidental. The life assurance. The life assurance is one important branch of insurance which is taken as a protection against loss caused by the death of a person. This policy covers human beings and not properties. The risk covered here will inevitably occur, but the time of occurrence is what is not known. If the life assured was suffering from a serious illness at the time of taking out a policy unknown to the assurance company, the latter may disclaim liability. There are four main types of life assurance, namely the term assurance, the whole life assurance, the endowment assurance, and the annuities assurance. In term assurance, payment will be made to the assurer if the life assured dies within the specified period. While in whole life assurance, this type of life assurance will last for the lifetime of the life assured, and the sum assured is payable only at death. The endowment policy is a type of policy which provides for the sum assured to be paid either after a fixed number of years or at death, depending on which occurs first. Annuities is a form of pension in which an insurance company, in return for a certain sum of money paid in a lump sum or by installment, agrees to repay this money plus the investment income that is able to earn over the expected lifetime of the investor or for a specified period. Reasons for taking life assurance includes: 1. Life assurance policy provides for a lump sum of money on retirement, and it's a means of saving for the future. Life assurance makes provision for permanent disability. Life assurance policy can be used as a collateral security to obtain loan from banks. Life assurance is a source of loan repayment. Life assurance policy provides for one's dependent in the event of death. Life assurance policy makes provision for the repayment of capital on the death of a partner. Life assurance policy is used as a way of providing for old age. Fire insurance. Fire insurance is a type of insurance which provides cover for loss or damage caused by burning. Fire insurance may be taken with average or without average clause. Fire insurance with average clause. If the fire insurance policy contains average clause, the compensation will be based on the actual value of the building, the amount for which it was insured, and the total loss suffered. The compensation will be calculated thus: amount insured multiplied by the actual loss divided by the value of the property. Amount insured multiplied by the actual loss divided by the value of the property. Fire insurance without average clause. Under fire insurance without average clause, the insurance company will only be liable for the estimated amount of the loss. Take for instance, if the property is 25,000 and the insured amount is 13,000 and the loss is assumed to be 10,000, the insured will only receive 10,000 as compensation. While in fire insurance with average clause, take for instance, if the insured amount is 10,000 and the actual value is 30,000 while the actual loss is 15,000, following the formula, which is amount insured multiplied by actual loss divided by value of the property, which will be 10,000, which is the amount insured, multiplied by 15,000, which is the actual loss, divided by the value of the property, which is 30,000. You will find out that the compensation will be 5,000. The difference between contribution and group insurance is that contribution deals with the principles of insurance, while group insurance deals with the types of insurance. In contribution, risk is insured with many insurers, while in group insurance, many people or group of employees take a single policy. In contribution, each insurance company involved will be liable for only a proportion of the liability, while in group insurance, the company is liable to everyone covered by the single policy. Let's also look at the underwriting and reinsurance. Underwriting is a process whereby a merchant of insurance company undertakes to cover, underwrite a portion of a risk or assume part of a risk. This is common in marine insurance because of the enormous cost involved, which cannot be borne by one insurance company. An underwriter is a marine insurer who offers to cover, underwrite, or assume a portion of a risk. The underwriter would write under the details of the risk, his name, and the proportion he has accepted. Reinsurance. Reinsurance is a situation whereby an insurer agrees to insure with another insurance company all or part of the risk. By spreading large risk among many insurance companies, losses will be reduced. For example, the insurance of a large vessel will definitely involve a very heavy claim. The insurance company can therefore reduce its potential loss by spreading the risk to other companies, whereby both of them will be liable for the loss. Reinsurance is the transfer of risk from one insurer to another and provides additional security to the insured and all other policy holders. Let's also talk about the middlemen or intermediaries. Let's also take a look at the middlemen or intermediaries. The intermediaries in the insurance industry can be classified as insurance agents and brokers. Insurance agent is somebody who is employed by the principal to bring him into a contract-based relationship with a third party. Insurance agents act on behalf of insurance companies on part-time or full-time basis. The part-time agent is an agent who brings the insured to the insurer. The agent that performs this function usually is a sideline. They are in different professions such as banking, accounting, etc., which frequently bring them into contact with people seeking insurance. The full-time agent. This is employed by the insurer on full-time basis. He is paid partly by commission and partly by salary. Full-time agents are staff of the company who go about canvassing for the insurers. Insurance brokers. An insurance broker is a person who negotiates insurance cover with an insurance company on behalf of a client. They are experts in insurance who offer advice and professional assistance in arranging insurance policy on behalf of their clients. Differences between agents and brokers includes 1. Brokers are full-time professionals while agents are always on part-time basis. Brokers can be sued for professional misconduct, while agents cannot be sued for negligence. Brokers are paid with higher commission, while agents are paid with lower commission. Brokers are experts in insurance business, while agents do not profess to be experts. Insurance is important because it facilitates international trade, it offers investment opportunities, it leads to risk reduction, it provides a means of savings, it provides security, it serves as collateral security, it helps to motivate workers, it also provides for old age and disability. Procedures of insurance contract. The insured will make an inquiry through his agent to the insurance company. After due consultation, he will obtain a proposal form. The form will be filled and all relevant information relating to the insured must be truthfully stated and signed by the insured. Consideration in the form of premium will be paid to the insurance company on a weekly, monthly, or yearly basis, depending on the agreement. The insurance company will then issue out a temporary cover called cover note, which gives him a temporary cover while it is being processed. After processing, the insurer will issue out an insurance policy to the insured. This policy will give detailed terms of the insurance contract and make the insurer liable for losses or liabilities incurred as a result of the occurrence of risk insured against. Some terms frequently used in the insurance industry includes proposal form. This is a form that must be completed by a person wishing to enter into an insurance contract. He must disclose all relevant information truthfully in the form. The cover note. The cover note is a temporary insurance cover to enable the insured to enjoy the benefits of a policy while it is being processed. The actuary. This is a person involved in life assurance, assessing the risk and calculating the premium and handling matters connected with pension funds. The insurance policy. This is a document which sets out the exact terms of the insurance contract. The surrender value. This is the amount in cash an assurance company will repay to an endowment policy holder if he wishes to discontinue